Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it's my pleasure to be your host for today's episode. In today's podcast, we'll be looking at what happened over July 2025, and we'll be discussing the outlook going forward. This podcast is being recorded on Wednesday, the 8th of August 2025. And joining me again today is our Chief Investment Officer, Rob Hogg. Hi Rob, welcome back again.
Hi Steve, thanks for having me back again.
Thanks so much for your time. Can we start with what happened in July? Key market movements.
Yeah, no, let's do that. Although in some ways it's sort of ancient history. It was ancient history pretty quickly. But look, broadly speaking, equity markets were higher. NASDAQ did best globally. And look, we think a lot of that was because a number of these trade agreements were reached. EU-US was probably the most important. Now, we say trade agreements, there's not a lot of detail and there's not even certainty about the legality of these. But anyway, in the market's mind, this was progress. So that was, along with the fact that US data, up until the 31st of the month anyway, was still reasonably resilient. Slowing, but reasonably resilient. That changed, or seems to have changed, come August the 1st. But back in July, we saw yields rise around the world across the yield curve. A little bit more at the shorter end of the curve. This is what we call a bear flattening. So bear meaning that prices are falling, yields are rising, and a flattening to convey the fact that shorter term yields rose by a little bit more than longer term yields. And that was consistent really with what we saw in equity markets, and that is that growth still seemed to be reasonably resilient. And with that, the market's implied probability of rate cuts declined very slightly during the course of the month. US dollar also on the increase in the month. That's the first time the US dollar's risen on a trade-weighted basis so far this calendar year. And again, what lies behind that is this continued resiliency in the data during the course of the month. And also the fact that inflation pressures certainly haven't gone away, and if anything, they seem to have started to pick up.
So we've got a situation where I guess the spectre of stagflation has increased. As you mentioned, it is almost ancient history because on the 1st of August, we saw some really quite interesting US July job numbers. And as a result of these, the chief of the bureau that issued them was sacked. Can you go through what they were and what the implications were for the market?
So these were, and look, these numbers are always revised month to month. The US, like every country, does a trade-off between timeliness and accuracy. And what that means is the earlier you release this data, the more likely it is to be revised. And the US released data probably earlier than almost any other country in the world. So anyway, on the 1st of August, the July jobs report was released. For the month of July, not a huge surprise, 73,000 was what the Bureau of Labour Statistics said was the job creation number. But what was shocking was the very significant size of the downward revision to the previous 2 months, April and May. And that's the largest 2-month revision since 1968. And that has really been what has shocked the market. That history has, in a sense, been revised to show a much weaker profile. That, as you said, has led to the sacking of the lady at the Bureau of Labour Statistics who's in charge of putting together this report. And as we speak today, we're waiting to see who might be appointed to that job. But this has implications in that agency, not only for these labour force data, but also for the CPI, because the CPI is actually put together by the same statistical area in the US. And that obviously has significant implications. Anything that leads to a questioning of the veracity of the numbers could have very significant negative implications for US asset prices.
And look, it's a bit of an odd thing to sack the messenger or shoot the messenger as such, because he is arguing for the Federal Reserve, the US central bank, to cut rates. Now, the central bank left rates unchanged, and I'll ask you to talk about that in a sec, but this July jobs report actually gives pressure on the Fed to cut rates, if anything, and yet he's questioning, as you say, the veracity of the numbers. So do you want to talk about what the implications are for rates and that sort of thing?
Well, let's just deal with that issue about how, on the face of it, these numbers suggest that the likelihood of the Fed cutting is greater. That's absolutely right. He's been calling for rate cuts. But the catch, of course, is that they also reflect a slowing economy, and that's not something that Trump really wants to be associated with. So if we've all heard the term cake and eat it too, this to me is Trump wanting his cake and eating it too. He wants to have the rate cuts, but he doesn't want to have the reason for that, ironically, being weakening in the economy, saying that reflects poorly on him. That's my sense of what's going on here and his reaction. What does it mean for rates? Well, certainly the probability of a rate cut next month in September has gone up. We had some numbers last night, as we do most nights in the US. These were for what's called the ISM Services Purchasing Managers Index. This is a survey of conditions in the services sector. This has continued to soften. It's still expanding very slightly, but its rate of growth is slowing right across the board, whether it's orders, whether it's employment. But the one thing that isn't is prices. Prices are continuing to accelerate. Perhaps this is tariffs. And we had feedback last night from Caterpillar, in fact, talking about some of the costs going into their business that are directly attributable to tariff increase. So this is the dilemma for the Fed. Activity seems to be more broadly slowing, but price pressures are showing signs, if anything, of just starting to pick up again. And that was something we saw in July as well with the latest consumer price index, a slight increase in the momentum of month-to-month change. And that's before we see really clearer signs of tariff-based upward price pressures.
The Fed's more concerned about price stability, isn't it, than the economy? Is that a fair comment or not?
Look, they do have a dual mandate, both employment, which I guess we take as growth, employment and prices. Right. And of course, the emphasis they put on either of those sort of depends on the context.
Yeah.
So at the moment, it's very tricky. The growth side seems to be softening, whereas the inflation side, if anything, seems to be gaining a little bit of momentum. So that is like a classic policy dilemma for the US Fed.
And it obviously makes it hard for markets to really power forward in that sort of uncertainty. And it probably brings us on to another point, which is Chairman Powell's replacement. So he's retiring or being retired, whichever way you look at it. So have you got a sense of who the replacement is?
Probably the latter. Yeah, so this has all come up and come forward a bit because one of the Fed governors, Kugler, has resigned, effective immediately, in fact, effectively the 1st of August. So that leaves a position vacant on the board. Now, just overnight, we've had feedback that Secretary of Treasury Bessent is not interested in the role. There are a couple of front runners for the role. Now, this is an appointment by the administration. Kevin Hassett is one of the potential candidates. He's director of the National Economic Council, so that is an administration-appointed role. And the other candidate, also cleverly called Kevin Warsh, he's a former official with the Fed who's not been on the Fed for some years, but I think he's actually got a very good reputation, a very solid reputation. So it's not necessarily the case that a Trump appointee will be a significant negative from the market's point of view. I think Warsh would be reasonably supported. Another potential candidate is Christopher Waller. He's actually a current governor of the Fed Reserve, and he's one of the voters who's been dissenting in the last several decisions. He's been dissenting in favour of a rate cut. So he's seen by the market, by virtue of what he says, as being more toward the dovish end of the rate spectrum. By dovish, we mean more likely to cut rates than someone at the more hawkish end of this delightfully named Avery scale.
Okay, so difficult times ahead for the Fed in terms of making a decision. So you talked about Caterpillar last night, and clearly companies are seeing pressures, input price pressures from the effect of tariffs already. How has the earnings season been in the US? Are we seeing widespread effects like that?
Look, we are getting calls regarding tariffs, but so far what seems to have occurred is the companies are really talking about strategies to try and manage any potential tariff-related pressures, so trying to manage their supply chains more tightly. Some of them are increasing their prices, some of them are cutting other costs to try and manage it. Now, of those companies discussing the impact of tariffs through the reporting season, around a third are saying that they expect the profit headwind from tariffs to be smaller in fact, than their previous estimate. So look, so far, it's not been quite as significant as investors may have feared, but I think it's still possibly quite early. And as I mentioned, we had only last night Caterpillar talking about a very significant cost to their business. They estimate a full year cost of 1.3 to 1.5 billion full year impact from tariffs. They're talking about sales being hit by tariff uncertainty, and they're talking about increased manufacturing costs due to tariffs. And I imagine we'll continue to see those types of reports from those types of companies.
And this is the problem that some of us have had with the tariff concept, that ultimately it's either profits in the US or it's the consumer who pays the increased prices. And one of the reasons that Trump gave for raising the tariffs, other than raise money, was to encourage companies to onshore. And I don't think we're seeing evidence of that, are we? That companies are changing their CapEx direction?
Well, we've seen a bit of talk, but of course it takes years and years to actually bring about
that's right.
these sorts of changes. And it's hard to imagine companies making huge changes given the nature of the policy uncertainty, or the significant degree of policy uncertainty that we've seen with the current administration in the US.
Yes, and I think in that sense the market has, you'd have to say, been relatively solid in the light of continued uncertainty. Another thing that happened in the middle of the month was that Congress passed the Genius Act, which regulates tokens that they're calling stablecoins. So, Rob, I've got a couple of questions here for you on this. First of all, can you please define what stablecoins are and talk about what the Genius Act represents?
Yeah, so let's hop into this because this is going to be, and already is, incredibly significant. So just to a definition, stable coins are a type of digital asset, and they're designed to maintain a stable value relative to a national currency, and they're backed at least one-to-one with safe and liquid assets. So they're very different to what we understand from as people talk about cryptocurrency, Bitcoin and so on and so forth. Stablecoin are very different. They are backed one-to-one with safe and liquid assets. So that makes them quite a different beast.
And these liquid assets are things like US Treasuries, US dollars and that sort of thing.
Yes,
so
US dollar assets.
in a sense, they're fully funded and therefore they're easy to determine the value of, as opposed to a crypto where the value is really up to the beholder.
That's exactly right. And what's so important about the Genius Act? Well, the Genius Act really requires this 100% reserve backing with liquid assets like US dollars or short-term treasuries, and requires issuers to make monthly public disclosures of the composition of reserves. So this is really the regulatory framework for these stable coins. And that's why the Act itself was so incredibly important. And look, after the passing of the Act, we saw that the heads of the largest banks in the US are now talking about creating their own stable coins.
Right, backed by US Treasuries and so forth.
And in fact, look, I think about 99% of stable coins are all backed by US dollar assets. They don't have to be, but it's just the case that so far they are. So stable coins can be traded, and already are, traded on exchanges. They're also a means of accessing and holding US dollars. So for example, they could be particularly appealing to people living in higher inflation countries, or those without easy or affordable access to dollar cash or banking services. And they could also be used for cross-border payments from one country to another, and potentially more fully for retail payments. And already we're seeing that firms that provide point-of-sale technology are acquiring fintechs or developing their own capabilities to accept stable coins for retail purchases. And I think we're right at the very beginning of that.
That makes sense, right? So if you're talking about PayPal, Visa, and those sort of instantaneous payment mechanisms, the use of stable coins gets rid of a layer of costs and speeds up the transaction. So from the retailer's perspective, maybe they get the money a bit earlier. I get the argument why a user might want to use it for a short-term transaction, but given the structure of stablecoins is that the issuer keeps the interest earned on, say, US Treasuries, they're making a lot of money, and I can imagine all the investment banks will be scrambling over this as an exciting way of making even more money. Why would anyone hold a stablecoin as an investment given that you're not getting interest on it?
Well, I'm not sure that you necessarily would hold it for investment for exactly the reasons you say. You don't get, well, you're very unlikely to unless the issuer is about to share the interest earned on the underlying assets backing it. And of course, that's the key to the business case for actually creating these things. But it's more that by giving you access to an asset backed by the US dollar, if you were looking for US dollar assets. But you might wonder, well, why wouldn't you buy a short-term treasury security? These would be a little easier, I think, for most people to trade on an exchange. So that ease of use might be one of the reasons.
Because the way I understand it, as long as you've got some sort of wallet, electronic wallet, you can literally just buy these things on your phone, whereas buying a US Treasury is probably a little bit more complex. And certainly I would have thought that for international people, if they want to buy US dollar assets, say they're buying something in US dollars and they want to get the money already over there, then this is going to be a much more effective and potentially transformational way of doing business. So it's going to be interesting to see how it goes. But once again, the genius of the genius is that the investment banks keep all the interest. So they'll do very well out of this, one would have thought.
Well, there's that. And look, they're also likely to generate fees, charging fees as well. And look, potentially they could even use stablecoin issuance as a loss leader to entice customers to use other products or services offered by the stablecoin issuer. So it makes, in some ways, makes a huge amount of sense from the issuer's point of view.
Absolutely.
Whereas its use case will be quite particular, probably quite retail, as we're saying. But just back to the Genius Act again, the key with the Genius Act is that it has set up the regulatory regime for stablecoins in the United States.
Right.
And that will be key to really speeding up the development of these.
Yeah. And a lot of other central banks and other countries are looking at this sort of thing. So they'll be looking at the regime and seeing how successful it is. But one can't help feeling that it will be widely adopted pretty quickly.
Yeah, you would think so.
So it wouldn't be a month's end, Rob, without talking about tariffs, which we've done for the last few months. The EU and the US came to an agreement. Can you talk us through what that agreement was, whether it was better than expected, worse than expected, and the implications?
Well, I guess when we talk about better than expected, if we cast our minds all the way back to, say, September last year, before the presidential election, through September, October last year, the likelihood of Trump winning the presidency increased in the market's mind, and that started to see, in fact, a selling off of the euro and a selling off of European equities, and that lasted pretty much all the way through to the end of the year. And there was a fear and concern about tariffs. Then we enter 2025 and we started to see the reverse, that the market felt it had probably become a little bit too pessimistic about the outlook for tariffs. And then all these concerns about US policy volatility and uncertainty and maybe the end of US exceptionalism, all of that then started to pervade US markets, and we saw European markets do much, much better, both absolutely and relative to the US. That's now sort of turned around again through July, and we've seen the whole AI thematic take off again. And so in that context, these 15% tariffs, they in the end were probably no better, no worse than were feared. Interestingly, markets sort of sold off after the announcement toward the end of the month, but still ended up in Europe just very slightly higher, their equity markets. But there has been an awful lot of pushback, political pushback. France's Prime Minister calling the deal a dark day, adding that the EU had resigned itself into submission, and similar comments from the German Chancellor as well, very negative. So, look, I think this is one of the cases where the uncertainty having come and gone, that was the really only positive element. But if we look at the situation we have now with the effective tariff rate on European exports into the United States, that is clearly higher than was the case at the end of last year. But markets have sort of looked through that for the time being.
Well, I guess the proof will be in the pudding. What happens to the rate of exports to the US from the EU, and whether the US consumer and the US businesses choose to absorb part of that tariff, it might not end up being that bad for the EU. I mean, at the end of the day, if you're a wine drinker and you like Burgundy, you're probably still going to buy it. Because presumably the wine seller will absorb part of it, and maybe the EU exporter will absorb part of it, and the consumer will absorb part of it. So maybe the net.
That's right. That's why it's so hard to model these things, because there's not a one-to-one relationship. So in the case of Japanese autos, for example, there's evidence that the exporters have cut their prices. So they're eating part of it. And you're quite likely to see, as you're suggesting, in the US, that the importers and distributors may well eat some of the tariff as well. And like all these things, it'll depend on the relative strength of demand and pricing power. And that will vary from product to product, service to service, I would imagine. And it will vary through time as well, according to how strong or weak US demand may be. So it'll be distributed. It's definitely an extra cost on doing business, but it has had a benefit to the US Treasury coffers. They have started recording increases in tariff payments, and quite significant ones so far.
And that obviously was one of the main reasons for doing it. Okay, Rob, thank you. Let's move to Australia now. The market, pretty much 100% of the market expected an RBA cut in July, and yet they didn't cut, to the surprise of most of us. Can you talk us through that?
Yeah, look, I was surprised as well. So what's happened is several-fold. Firstly, the case for a rate cut is, as always, a balance between really inflation and growth. Inflation's moving in the right direction. Clearly, the RBA doesn't think it's moved sufficiently into its 2% to 3% band. And that's one of the reasons they said they weren't going to cut. And as well, the labour market has been reasonably tight as measured by the unemployment rate. So in that context, the RBA again didn't feel that now was necessarily the time and that they could continue to afford to wait given the uncertainty. So that's a backdrop. But what has changed is that we've now got this monetary policy board. This is different, and the majority of the people on that board are independents. Now that is different. And the governor, Michelle Bullock, went through this in some detail in her post-non-decision press conference, that she effectively cannot know ahead of time exactly how the committee is going to vote. And that makes it impossible for the Reserve Bank to do what they used to do, which is what we call jawboning, where they would often provide a view through a well-sourced or a well-respected journalist, was usually how they did it. And they'd use that journalist and that leak, if you like, that calculated leak, to move market sentiment. They now can't do that because they don't know what the vote's going to be. So what I think this is going to do will lead to a bit more volatility, perhaps a lot more volatility on decision day, when if the market's of a mind to move in one direction and the RBA and its monetary policy board in particular are of a slightly different view, we will get this volatility. So this is the new regime.
But what was the rationale? You're saying that the inflation rate is in the band, and you're talking underlying inflation here, I guess. It is in the band, yet they chose not to cut rates because the unemployment rate at that stage was still too low. Is that their reasoning?
We are broadly speaking. So the governor reiterates several times that it's just a question of timing. It's not a question of direction. It's a question of timing, wanting to get more information before cutting rates rather than direction. Rates are still expected to fall. That's really where they're coming from. And tariffs, obviously, are one of the key areas of uncertainty. So in that sort of context, and the fact that the economy, if anything, showing some very slight signs of perhaps improving off the back of the 2 rate cuts we've already had. Look, in their mind, rushing through these things is a risk they don't need to take. The lesser of two evils, I think from their point of view, is to wait and perhaps be a couple of weeks late rather than cutting and finding, in actual fact, inflation hasn't quite got where we want it to, and in fact it's not decelerating anymore. So in that context, the risk of cutting and having an inflation pickup is much, much greater than the risk that might accompany waiting fractionally too long.
So the market is now expecting the next meeting to cut rates. Has there been any subsequent data that would support that, economic data?
Well, we've now had the quarterly consumer price index rather than the monthly one, and that was important too, that the most recent data point for the RBA was one of these monthly numbers, which are not as comprehensive. They've now got the full set of data, which we get quarterly, and that was pointing in the right direction, if you like. They've had that, and we've actually had an employment number that was a bit softer as well. And of course, we've had what's happened in the US, and what happens globally does matter. If the likelihood, particularly of the US cutting rates or increasing rates, is going up or down, that can have an impact on what the RBA does, because global conditions do affect Australia. So of almost all central banks, we've traditionally paid more heed of what's happened globally. It's not the main thing they look at, but it's always something they do bear in mind. So the fact that US probability of rate cut has moved toward greater certainty would be expected to further increase the likelihood here as well.
Well, I mean, from a personal perspective, I just think while it might be right to be cautious, I think they also risk an economy that slows faster than expected, and they're not positioned for it. So from that perspective, I think given that inflation has got back into the band, albeit at the higher end of the band, is that fair to say?
Oh, well, in some measures, it's well through the midpoint of the band. But, I mean, they look at these key underlying measures, these trim means and medians, for good reason. And they're towards the higher end, but they're within the band.
Right. Well, time will tell on that one. So let's look at the reporting season, which has just commenced. It's obviously very, very early days. Has there been anything coming out of it or anything you're expecting to come out of it?
We've had a couple of profit warnings, discretionary, retail discretionary related, consumer discretionary related. So the sorts of trends we see in that area will continue to, as they always are, will continue to be important. A story with banks and margins and net interest margins in particular, that will be a focus. We know how powerfully the banks have performed, particularly CBA, obviously. So the market will be very, very focused on that. Outlook statements, they're always a key. So are companies at the point where they can provide any guidance at all that the rate cuts we've had have started to suggest any sort of pickup at all in terms of demand? So broadly speaking, those are the major sorts of trends. Anything else we might get about the nature of, say, Chinese demand, those types of things, and the situation in China, that'll be important, of course. But it'll be those industrial companies and those consumer discretionary companies that give us probably the pulse of the consumer. So it'll be interesting to see what sort of reading there is.
Well, we'll have a lot more to talk about on that side at the end of this month. So, Rob, wrapping it all up, the outlook, we've been relatively cautious for the last few months, given the volatility out there, the volatility of tariff announcements and that sort of thing. Have we changed our outlook, or are we still pretty much the same as we have been the last few months?
Look, we are a little bit more cautious, and the reason for that is that the last month suggested, the last 30 days, 31 days suggests that the US is sailing into slightly more troubled waters, and by that I mean specifically a slight pickup in inflation and a slight speeding up in the rate of deterioration in the economy. Now that is not a great combination, because that inflation story at the margin could constrain the Fed's policy freedom to cut rates should we see continued falling away in activity in the US. So that setup, if you like, along with the fact that valuations remain at the very top end of their recent ranges, so expensive, that's just not a great setup for risk assets in the next little while.
Yes, I mean, at the end of the day, as you say, there's more downside risk than upside risk under that scenario.
Yeah, so some might describe this as stagflation, and perhaps it's a very tiny wee sniff of that, and that's a very treacherous, very uncomfortable background for a central banker and frankly for an investor.
Yeah, absolutely. For markets, that's right. Great, Rob. Thank you again so much for your time. That brings us to the end of today's podcast. We looked at what happened last month in July. We've looked at what it means. And again, unpredictability, volatility, that sort of thing is going to hang around for a while. And in that context, we've got a market that is evenly poised, but there's certainly slightly increased risks on the downside from our view. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcast from. And please do let us know if you've got any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation or needs of any person and should not be considered a recommendation.